I know it's so tempting to ignore the day-to-day because we really are focused on long-term and long-term investment strategies. But when you see these big swings, and dare I say it, maybe some of these dip buyers really coming in, clawing back up into the green as you head into the close, is that a sign of sort of that washout you had mentioned earlier, that you think it still could get maybe a little bit worse before it gets better? But this could be a signal, no?
It could be. I will say, what was interesting about today with the 10% drawdown is that's typically the tail end of your garden variety correction. Anything worse than that post-financial crisis tends to be in the -15 to -20% range. And those are real, true growth scares. Now, the composition of the market was different back then, so things are a little bit different today. But I do think you have to ask yourself as we go through this drawdown, how much at risk are we of a true growth scare, of some kind of true growth hit to the economy? And if you think that that's not the case, then 10% may be the right number. If you look at, sort of the levels we've been trading at on the S&P, and I'll spare you all the math, but if you kind of do the work to figure out what the historical multiple contraction is using current consensus earnings estimates, the levels we've been at the past few days have basically been consistent with those average type of Fed repricings. So I think you can make arguments both ways. But again, I do worry that perhaps we haven't seen as much froth pulled out of tech as we need to. And tell you, Taylor, what's really, really interesting, consumer discretionary beating tech on the day. The valuations in discretionary have really improved year to date. They haven't in tech. That shows you there is some valuation sensibility in this market right now, that people are trying to find those true bargains.